Hello, this is Jeffrey Cohen. How are you? President and founder of Chicago Quantum. I'm here for week 16. We're going to talk first about the firm, and then we're going to talk about the markets. Got a lot to share. It's been a busy week. It's actually it's been a very productive week for our firm. So why is that, Jeff? Well, we made progress both on the technology and in our Chicago Quantum Net Score model. So I want to talk a little bit about that. What I'm showing you is actually we took all the notes from the meeting that we're going to have now, and I put them on our website. There's actually a weekly update blog page, and so every week we're going to put them out here. So, all right. So first thing is our firm has made progress in its work. We have now 2 clients. Second client is starting Monday with paid work. We're going to be working on virtual reality and song lyrics with quantum algorithms. By the way, how cool is that? And so imagine you're in virtual reality. Got your glasses. I got a pair of glasses here. So you put on your virtual reality glasses. See, like this. And now you're playing a game and you're doing stuff and you're like, oh my God. And all of a sudden the virtual reality system says, boom, you should be in a different world now. And now all of a sudden you're flying and all of a sudden now you're on a roller coaster. And that's all going to be fed data about you, your metadata, to a quantum computer and the different worlds you visited, and then come back and, hey, what do you enjoy? So good news is we're doing that. I think it's going to be terrific, and we're working in close partnership with our client and with a quantum technology firm. So, good coding. Also, want to talk about we sent a proposal to a third client right now, and the idea would be let's use the model, let's do custom programming, let's do data analytics, and let's pull it together. And we're starting to attend different procurement fairs for U.S. government clients. So hopefully we start to grow. Then we buy that office I've had my eye on, and we fill it with people. And so that's our goal. So the other thing, and I know we've talked about it, but it's pretty cool. We've actually replaced all of our core technology. And in fact, I got a package here. Some of the old technology, I'm able to still buy some upgrades. So I got the old technology. We're going to do an unveiling now. And we got the new tech. And the new tech's pretty awesome because it's like the server. You hear that? That's a server right there. 4 times. It's got 4 times the power. Oh, look. Got some more RAM. It's pretty cool. In fact, for the new server we bought from Dell, it has 192 gigabytes of the highest speed RAM we've ever run. It's actually very high speed, and it's got 8 cores, a very fast 8 cores for an Intel processor chip that came out in 2019, and so pretty excited about that. We also have a new Imac Pro, which I know you guys knew about, and just terrific. It means we can run our analytics deeper. It means we can run better, deeper, better, and just better analytics. Based on that, we're going to be making some changes. So the other thing we did is we wrote a reverse simulated annealer. First off, what does that even mean, Jeff? So it means that we could take the best solution, the best interim portfolio solution that we can find, and we can make it better. So I want you to think about that for a minute. We've got this solver, platform with solvers on it, including virtually through a cloud link quantum computer. So we run our portfolio. We run 3,067 stocks last weekend, and we came up with a 128 stock portfolio of all-stars. And from there, we could pick the 2, 3, 4, up to a dozen stocks that our client should hold in equal capitalization. So $10 each, 10 stocks, wrap it up. But we wrote a reverse simulated annealer. So an annealer, a simulated annealer, which we write bespoke, it works off of temperature. So you're scanning for like a really good stock portfolio. And you're looking here, and you're looking there, and you're looking way over there, and you're looking behind you, right? You're moving everywhere. So what happens is, the earlier in the run, the hotter it is, the more you jump around. So I'm like an ADHD person, right? I'm looking in the box. I'm looking next to the guitar. There's a guitar. I'm looking in the books. I'm looking in the desk, everywhere, right? But as the temperature cools, I'm focusing on one place. I'm just going to look in the box. I'm going to find the best thing in the box. I'm just going to look over on the bookshelf number 2 on the right side. And so as the temperature cools even more, I'm done. I'm not jumping. A reverse annealer then takes those solutions and goes the opposite way. And so it says, you know what? I know I'm in the box. I'm in that optimum, right? So I'm going to look in the box. I'm going to keep looking in the box because maybe I find a better answer. But then I'm going to look broader and broader and broader. And to the extent that the answer is almost as good, I still might jump until I'm really looking. And so what happens is you broaden the aperture so that at the end, with a reverse simulated annealer, you're actually looking at potentially at the entire space of stocks one last time. It already knows the best stock portfolio. It already knows all that work that the Dell server did for 3 hours. It's going to take one last look. It's like a bird flying over the mountain. I'm going to take one last look for the deepest valley. And we did it, and it's the best solver right now. I mean, what it does, it's not, you wouldn't just run it, but you would run it in concert with all the others, and it makes the answer better. So, very happy. I want to thank David Venturelli and his work at NASA Ames, and I think it was with Barclays as well. So, David Venturelli was the first person that I know that did a reverse simulated annealer, a reverse quantum annealer run on D-Wave. And D-Wave makes it possible for you to run reverse annealing. And so I was in a conference at Quantum Tech, and I was reminded of the fact that, reverse annealing is pretty good in one of the talks. I said, you know what? I'm going to code it myself. Let's just do it. And we did it, and it worked great. So this is a big deal for us because it makes the quantum annealing better. It makes the classical quantum annealing or classical annealing better. And it just gives us confidence that when we do get the D-Wave to do all these things, we actually have a comparable answer as well. So one of the things that we do that's very important is we don't trust without verification. So if we're going to run something on the D-Wave or on any simulation software, we have to know the best answer. And so we're able to solve it perfectly, precisely in real life, and then run it on like a D-Wave or something, and then bring it back. And if they don't exactly match to the precision of Python, which is like 10 to the 19th power, 10 to the minus 19th, then I know we have a problem, and we have to go start digging into why it's not working. So, yay. I know everyone's so excited about the reverse simulated annealer that they just can't take it. Right. The next thing we did, and this may be a world record, at least it's a Chicago quantum record, is we got 142 stocks to embed on the D-Wave System Advantage 1.1. Why is this a big deal? Because I remember when we ran 40 stocks like a year ago. We were so excited. Yeah, 40. Damn it. We did it great, right? And then we got to 60 stocks when the theoretical maximum on the 2000 was 64 stocks. And we run 64 stocks all day long on the small D-Wave. I actually call it a 64-bit system. It doesn't make any sense at all technically, but you can put 64 fully connected vertices, clicks, on the thing. And so that's great. So the D-Wave System Advantage 1.1, theoretically you can fit 180. But truthfully, we've had success with 128. We can embed 128 all day long. It runs about 90% effective. So I call it a 128-bit machine because I can do 128 stocks. So I accidentally was running 142 stocks, sent it to the D-Wave, and we had made some adjustments. We basically rebuilt all of our matrices both symmetric matrices that are the full matrix and half matrices or upper half triangular matrices. There were some mistakes. There were some things that just made it a little cleaner. And by doing that, maybe we took the load off of D-Wave for all the conversion, so it embedded better. So we've now run 142 stocks on D-Wave. I can say it's the best we've ever done. Who knows? It may be a world record, a quantum world record. I'd like someone to call us out and say they've run more than 142 stocks on the D-Wave. I dare you. All right. More work, more work. So, what else? We're accelerating our code. So, the good news is one of our team members is a PhD in math and is really good at Python. And he just reminded me of some facts. And we were going through the code. He said, Jeff, every time you do a loop, do a matrix operation. I've got a book on matrix math, finite matrix math, and unfortunately, I can't read it. I don't understand it very well, but what he said was, if you can create matrix operations one time, it's so much faster than looping, especially when you have thousands of stocks. And so we did that. We did that this week. I've got the code. It's not perfect, but we have a production run this weekend, and I may try to get that code into production this weekend. I think we're going to cut more than an hour off our run. It's one line of code. It's awesome. It's awesome. And on data validation, we're finding some other stuff as well. Now, that's not done, but I will tell you that we're just speeding up the code like crazy. Now, here's why. The faster we run our code, the deeper we can run our solutions. So if it takes me 10 hours, I'm not all that excited to run another 10 hours for $750, right? That's killing me. And my wife gets mad because she wants to do stuff. But if I can run all the code in an hour, then I could I can use certain solvers. I can do different things. I can run different indices. I can try things and potentially find better stock picks. So the other thing I want to talk about is we're in the process of adding a whole nother stock exchange to our model. So right now we run 4. We're looking at adding a 5th, which is the Nasdaq Capital Markets. The Nasdaq Capital Markets has 774 stocks. We'd be adding it, and all of a sudden, instead of talking about our 3,000 stock portfolio optimizer, it's a 4,000 stock portfolio optimizer. Pretty excited about that, actually. Everything takes longer. It's harder, but this would allow us to capture listed stocks that are smaller. Smaller market cap, maybe newer, maybe less compliance, but on the other hand, more stocks. So let's take a look. So, oh, wait a minute now. There we go. So that's pretty cool. What happens? So after you do this, why do you care? Because maybe we can go global. So that becomes the real pull here. You guys like the sweatshirt? Are you ready for quantum? So think about it. So we have conversations going on in Europe. The Europeans may not care what happens in the New York Stock Exchange. They care about the DAX. They care about the FTSE. They care about the CAC. They care about their stock exchanges. So it'd be nice if we can get our model tuned up so it can handle, let's say, a European stock run, an Asian stock run. That would be great. It's going to take some work, I know. So the other thing is we're in talks now with another data provider to see if we can make a deal, an affordable deal for us because we're a small firm, and then I'll be plugging that data provider constantly if we get a good price. But that would allow us to have, at least US-wise, another source of data. So if we ever have any trouble with our market data provider, we have a second one lined up. So that's what we're hoping for. So that's it in terms of the business. We're working as a team. Got a client meeting on Monday. We got another client who's thankfully knocking on wood paying the bills, and all new equipment, and it's actually a heck of a lot of fun. So I'm going to type in here to see if anyone maybe wants to ask a question. Ask a question. All right. So next thing I want to talk about, I'm going to make this a little bit smaller. Actually, I'm going to make it a lot smaller, and I'm going to show you pictures, because everyone likes to see pictures. So over the past month or so, there's been significant economic news. So Jeff, what do you mean? Well, let's start with the dollar. There it is. I want you to take a look at the dollar index. Really? Hope it's going to show it to me over a year. Here it is. So this is a dollar index versus some exchanges. And so I'm going to end up breaking what I was doing in the other place. So I don't want to do that. So I'm not going to show you this way. This is not what I want to do. Hang on a second. Dollar index. Let's just look for 5 days. And you see all week, down on Monday, up on Tuesday, down on Wednesday, up on Thursday, down on Friday. That's not normal. And if you look at it over the month, you see the dollar has gone up quite a bit. Strong dollar, led by strong yields, strong long-term yields, government bond yields, right? Weaker dollar, weaker yields. So why would that be? In part, it's because the Federal Reserve Board, that's not helpful to you. Here we go. U.S. government bonds, the long bond, 10 years. Here we go for the 10-year. So you see this chart. You see what it looks like. You see it curves up. The yields have been as high as almost 3%. It was about a year ago. And they plunged to basically zero. Imagine 10-year money. And it's gone up, but it's coming back down. The different yields are starting to peak back down. And so your yield curve is still almost zero through 2 years. And then it pops up to like 2.25. So yields are very low. And so the question is, what's the Federal Reserve going to do? And there's a feeling right now that the Federal Reserve is not going to drive up rates. It's just going to wait and see. And so, as a result, your dollar is coming down. Dollar was up because yields went up to almost 2%. Yields are back down to 1.5, 1.6. Right? We feel pretty good. We're bringing the dollar back down. Now, the dollar back down helps cure a lot of ills with our economy as well. So let's move that to the side. So, COVID-19 cases. Now, I'm not a big COVID-19 person. I don't really like to talk about it that much, but I am going to talk about it a little bit. So, let's bring this up. Not real happy about this. It's the world meter. So, daily new cases. Right here. Let's blow it up. I am really unhappy about this data. This does not make me happy at all. So, new cases are reaching an all-time high globally. COVID is back. The number of cases is actually exceeding the 7-day moving average. So, the number of cases is growing and continues to grow. We've exceeded the peak that we hit, it looks like, earlier this year. So, daily deaths, not quite as fast. I guess some of the developing countries have figured out how to handle it, but deaths are up. And deaths are far in excess of the 7-day moving average. And so, it's not good news, right? And so, it's possible that the U.S. government's going to wait and not tighten and not ruin the economic support that we've had. But don't know. And I have a hypothesis that COVID-19 cases are tied to the vaccine availability. And so the countries that have a vaccine are seeing less cases. The countries that do not have a vaccine have fewer cases. And so if I take a look at new cases, India, Turkey, I mean, the U.S. is always high. France, Germany, Iran, Italy, Ukraine, Spain, Poland, Netherlands. I'm pretty sure I've read that Europe cut back its vaccine rollouts because of some concerns with some of the vaccines. The U.S. Always high because we give people freedom. People don't have to wear a mask. They can go out. They can do what they want. We're a free society. Changes things. But other countries, Iran, Ukraine, a little bit poorer. And maybe can't afford the vaccines. And then you know the story with India. New cases, 345,000 new cases today. Reported today. That's crazy numbers. So I bring this up because I want you to know there's a backdrop around things like oil and gas, which is a global commodity. Global commodities, global economic conditions may or may not be improving. But in the U.S., holy moly. In the U.S., the job picture, I'm going to get rid of that. I don't even like talking about COVID. I think it's terrible. The jobs picture looks great. Strong, right? The housing market is firm. There aren't enough houses. Either we're going to build more houses, which creates jobs, or we're going to bid up the prices of the houses we have. Housing is going through the roof. Oil prices have been up and down and up and down. And so I want to talk about that a little bit because I have a feeling I'm going to see here. Let's look at it over a month, right? So over a month, I mean, things hit $58, right? This is the just a June oil forward month. It's up to 63, down to 61, but we're finding a nice, even, steady pace. Even look at it over the year. I mean, we started the year at $16, $17. It's unbelievable. It's unbelievable to think that a barrel of oil was that cheap. And then, you were in the 30s and 40s. And that wasn't enough to start drilling. It wasn't enough to really pick up economic activity in the United States around oil and gas exploration and production. But you take that price and it climbed up to $60 a barrel. It looks like right around February. Now at $60, it starts to be more economical. We've seen rig counts go up. Although today's rig count number from Baker Hughes, and I want to thank Baker Hughes every week for submitting the data. I think it's terrific. We're down one rig. But we're close to last year's rig count. We are actually catching up. And so the good news is more rigs today, or same number of rigs today, means more oil wells producing 6 months from now. It means oil and gas, it means pipelines, it means natural gas, it means availability of energy in the United States. And so if the price of oil were to keep going, let's say up to 80, you'd see a lot more production in the United States. But I'm not sure anybody wants to do that. And you can see some of the news here. Oil posts weekly loss with market facing patchy demand rebound. Bullish oil news offset by lockdowns in India. Record COVID cases in India could threaten oil demand. This is tough stuff, right? So we already have overproduction in the U.S. and over-availability of natural gas. The prices are weak, right? But now we're looking at oil. And if the price of oil is going to become weak because of COVID, you're basically just pushing off the recovery another 3 months, 6 months, until India and the other countries can control COVID in their countries. So it may take a while. So I also want to talk about Federal Reserve. Where is my Federal Reserve data? Factors affecting, no. Fred. Where's my buddy Fred? I'm going to have to pull it up. Total assets. Here it is. I actually made a picture, but it's always better to show you the real data. I know you appreciate it when because you can actually load this stuff too. So this is WALCL is the data series from the Federal Reserve. It's called Fred Economic Data. This is the amount of assets that our U.S. Federal Reserve System, our Treasury, holds. So if you think about it, when they hold assets, so it was like 7.2 trillion. When you hear that trillion, I feel like Austin Powers. $1 trillion, right? This is crazy. But we're at 7.8 now, 7.82 trillion. We're probably going to head towards 8 trillion in a hurry. So what does it mean? Well, the first thing it means is they're holding all this debt. Some of it is U.S. government debt. So the government is holding its own debt. It paid for the debt with cash because the world needed cash, reserve currency, and we're just holding the debt. The good news is we're holding the debt we're paying ourselves. So we pay interest to ourselves. That's helpful, right? But other debt in here is mortgage-backed securities. I want to say we have 2.8 trillion of this is mortgage-backed. Maybe now it's up to 3 trillion. That means people are paying their mortgages. The banks have sold off that mortgage debt to the feds. The feds are holding the bag. So as long as housing stays strong, the Federal Reserve is going to earn good money, really good money. And this is going to go help to pay for programs and stuff. At some point, though, we're going to want the $100 of cash back to give back that piece of paper, which gives us 3 or 4% interest. At some point. That's called tapering. So there was a question this week about, are we going to see a taper? And how do you taper, right? Can you imagine if the federal government said, you know what, I'm going to give back $1 trillion worth of paper. It's not even that much, right? They're going to have like 8 trillion, right? What happens when that happens? Well, they demand basically $1 trillion. They don't demand, but they sell $1 trillion of assets. Yeah. Where does the $1 trillion come from? Well, people sell their stocks in the stock market. People sell their bonds. So stocks drop. Bonds drop. That means yields go up for borrowers and stuff. Economic activity. So I'm a small business owner, right? Chicago Quantum, are you ready? Imagine if I have to give them back some money, right? Well, now I can't buy any more servers. So you can see the dilemma we're in. It seems like a good idea that you've got $7.8 trillion, $7.82 trillion of assets. At some point you're going to have to normalize and give it back. So there was conversation this week about, are we going to taper? Nah, probably not going to taper. But I just want you to think about it because that's just imagine this as a party that's gone on. See how long this party's gone on for. I love it. Well, let's just use the current part of the party. So the current part of the party started in 2020 when we were at 4.2 and now we're at 7.8. So we're $3.6 trillion party. Imagine a hangover you get at the end of a $3.6 trillion party. First off, with COVID, I haven't even had a party. You know what I'm drinking? I'm drinking Diet Faygo. By the way, I love that. You get 2.5 gallons of pop. 2.5 liters, actually. But gallons of pop for $1. You get it at Dollar Tree. Tremendous value. Great convenience. And sometimes you get surprised by the new products that they have. Such as different beverages. I love Faygo. Please don't stop selling it. So, there's a big hangover coming. It may not be ever. I don't know when we're going to actually cover that, but that's just know it's out there. It's a big number. Big number, big number. So, President Biden has announced a historic tax increase plan. It's historic because he suggested he'd like to double capital gains. Is this it right here? No. One of these? No, nope. All right, we're just going to talk about it. But I'm going to put up the budget picture while we talk about it, because I want you to forget for a minute all the politics, and I want you to just think for a minute about the budget. Okay, these are budget projections by the Congressional Budget Office, which is a nonpartisan, academically focused, numbers-focused look at government budgets. The outlays from the U.S. federal government, this is not including any state and local governments, so figure state and local, add 25%. I'm just guessing. So, it's not half, but let's go 25%. So, if your outlays are $5.8 trillion, maybe you go 7.5, which means revenues are maybe 4.5, deficit maybe 3.5, 3.25. And so, how do you cover a $2.3 trillion federal government deficit? Now, I have a client that talks about, hey, Jeff, the government's accounting process is different. That's fine. But how do I cover? I spend 5.8 regardless of what I spend on. Just assume the government does good things, right? That's political. But they spend 5.8 trillion, they take in 3.5 trillion. There's a deficit of 2.3 trillion. They got to pay for that. How are you going to pay for that? Well, the one thing you do is you make more debt. And I guess if the Federal Reserve can just pick up another 2.3 trillion of debt, you wash. Government prints the money. Boom! Inflation, baby. I'm gonna buy back that paper. I'm gonna sell the paper, and then I'm gonna buy the paper. Okay, first off, that's really weird, and it feels a little bit like Deutschmarks and Germany between World War I and World War II. I don't want to talk about that, but let's go back to normalness, right? So when the government doesn't just print $2.3 trillion of paper and start playing around. So one of the things you could do is you could do a $1 trillion tax increase. That'll help you. Maybe you bring your outlays down to 4.5, and maybe you increase your revenues by $1 trillion to 4.5, and now you've structurally balanced the budget. Biden's a hero. American people, I balanced the budget. But what's crazy is how he's doing it. He's going to go after people with capital gains. First off, people with income and capital gains. So I think about the stock market. I think about all those people that aren't working right now and they're making money in the stock market, and they love it because they sit at home, they work from home, or they work from home for a company, but they're trading a little stocks on the side, or they're trading crypto. They're having a good time, they're making some money. Maybe they're losing money, but maybe they lose money and they make money, and they make more money than they lose. But now imagine you're going to have to pay 40 cents on the dollar for every dollar you earn. By the way, if you lose, you don't get to write it all off. You just get like $3,000 off. So imagine you're putting $100,000 at risk. You can make $100,000, which means you make 60 after taxes, or you lose $100,000, which is really 99. It's not fair. The higher the capital gains tax on the plus side, the less fair it is, and the less people are going to want to invest in the stock market, in crypto, in bonds, in anything that gives them a capital gain. They're going to want to put their money in the bank. And that's what's happening. But then I read in the same article that the odds of the Congress supporting the highest capital gains tax in history is pretty small. So, on one hand, oh my God, Rome is burning. They're going to tax capital gains at almost 40%. And on the other hand, we're fine. Probably never going to happen. So that's just another story. Now there's one that's not in the book here. Russia. First off, I love some of these pictures. What does a Russian paratrooper look like? Looks like this. 1, 2, 3. They sit on it. They stand. They got short haircuts. They got airplanes with propellers that they jump out of. I just want you to think about it. Russia had anywhere. So Russia said that TASS said that they had 10,000 troops that took part in a snap inspection, right, by the Ukrainian border. The European Union thought it was 100,000, and Ukraine thought it was 50,000. So whether it was 50,000, 10,000, or 100,000 Russian troops, they were at the border. It's a little scary, right? It's a big deal. You got the press there. You got guys saying, look, I don't know what you're talking about. It's me and 4 guys. We're just going to get some hamburgers. We don't know what you're talking about, right? We just dug some trenches and we put in some heavy artillery and some, we're fine. We're just hanging out. We're having like a picnic, right? By the way, you notice the masks. Ukraine has an amazingly high level of COVID. So that your Russian soldiers are having to mask up. Although I don't notice all these paratroopers masked. So maybe when you're a troop or a ranger, I guess the Russian equivalent of a ranger, you don't worry about COVID. But so here's another case where a couple weeks ago, I was pretty worried. Russians, maybe they're going to invade Crimea again. They're going to go into Ukraine. From there, where are they headed, right? Hungary, Austria, I don't know. I don't know where they're going. Moldova? Well, they're already in Moldova for the most part. So, good news is they pull back. They're going home. Wrapped it up. Thank you, Russia, for not going to war. Appreciate it. So, just wanted to talk about that because I think it's pretty important. And, that's great. So, we talked about the budget. Talked about the Federal Reserve. We're going to talk about some more stuff. Dogecoin, Doggy Coin, holy cannoli, right? So, this is a new cryptocurrency. I've been learning a lot about cryptocurrencies lately because I am fascinated by cryptocurrencies. So, we're going to take a look at the crypto Doggy Coin. And I want to take a quick look at how this thing has done. So I really got excited about it earlier when it peaked up. So those are percentages. I actually want to look at this. Let's do an hourly bar. There you go. So we're going back to March. So in March, pretty flat. You see that? A couple of small breakouts, but not much really going on. You got a nice big volume day there. But for the most part, nothing's going on. And so what these coins are, there's new ones. There's Pomp Token. There's Safe Moon, right? I don't know what they are. So what's the first thing I do? I go over to my StockTwits. And I set it up for Dogcoin. And great memes, by the way. Terrific memes. And that number, oh, look at that. I just want you to look for a minute. So since we've started looking at this great meme, there's been 5 new posts on StockTwits. Now, StockTwits doesn't get a lot of posts. For the stocks that I follow, they maybe get 2 a day, right? So this number is 8 since we started watching The Matrix. So scroll a little bit. Oh, there's a dog sleeping. Dog's on the computer. Love it. Don't buy till we make a new high. Falling to its low. Gonna start pumping over the weekend. Oh yeah, chicken fingers selling now. You sold. And all this stuff, right? Woo! Great memes, right? By the way, 15 new posts, 16 new posts since we started coming. I'm actually tempted to leave this up for a little bit because in a minute we're probably gonna have 30 posts. So I started thinking to myself, why is that? Well, someone's making money on this. Someone's making a lot of money. It's not just the buying and selling like it was a stock. There's somebody that's making the coins or booking the sales and is making a profit on the activity. And so I'm not even sure I should tell you what happened. I'm going to tell you what happened. So I went out on Twitter and I created a list of promoters for Dogcoin. So this is 7 seconds ago. Okay, 8 seconds. Just hit a nice daily profit on DOGE. Bought in right after a large group told me to buy, and then they pumped the price. So, large group that pumped. So what happened was I noticed the same post going over and over and over again. So let's take a look. So if I just make this DOGE. By the way, this wasn't planned. I wasn't planning, but let's just take a look. 3 new posts right now. So you're going to see some activity happening in the Twitter world, in the StockTwits world. And so these are cryptocurrencies, and I understand from a new one called like Safe Moon. So you buy it. By the way, you can't buy it with cash directly, so you have to go in through Bitcoin or through Ethereum, through a crypto exchange. And then when you go to sell it, you want the money, right? You want to make a profit. They take 10%, or some of them take 7%, but I think it's 10% for Safe Moon. And then they distribute 1/10 of what they took, or 1/20th of what they took, to the other coin holders. Sounds like a Ponzi scheme to me. Right now, the 90-95% goes in the hands of the person that made the coins and all that. So we're up to 52 new posts. Let's take a click. Oh, we got, who's that guy? That's Rocky. The whales and dog are assholes. Everyone retweet. Why panic? Doja news. Huge news. Jeff Bezos accepting Dogcoin soon on Amazon. Look at that. So my guess is if I were to look at XXIIJMP with 19,800 ideas. So he posted it once, twice. Oh, Penny Pincher. Only 1 follower. So that looks like a new account. This is what you look for. Oh, another one. So this is what you look for. Oh my God. If you sell, then you just plain dog ugly. Panic sellers. So my point is, since we started looking at these posts, there's been 6 new ones. This is a process of people pumping Dogcoin. And so if you're even thinking about investing or getting involved, I would just be really careful because you follow the money. And so if people are spending money to promote, then you just need to be very, very, very careful. When you see very similar posts being retweeted over and over again or sent over and over again as original posts, you need to be careful. And the problem that I have is that you have people saying that it's a pump and dump. So my whole take on this is these cryptocurrencies, these new ones, seem shady. They're sus. They're not good. And that's going to affect Bitcoin. So let's take a look at how Bitcoin's been doing. Bitcoin's back to 50,100, which trust me is not a bad number if you bought it at 1,000. But it's down from in the 60s. And so as there's activity in like Dogcoin, and people buy Bitcoin in order to then convert it to other of these currencies through a crypto exchange, then that increases the demand for Bitcoin. It probably drives up the price. When these other currencies, these other coins start to drop or start to become less popular because you as a investor, as a customer, are being moved to new coins, then Bitcoin becomes more and more suspect with these other currencies. And so I'm watching with care and concern. I made a video about this. I'm worried that these cryptocurrencies, there's just too much crazy activity. Sylvester Stallone, that's his name. 32 new ones. No saggy boobs and reflected in the chart. I hate being right, guys. Start the party. Here you got a meme. You got more memes. Dump your bank account into Doge. You don't need electricity or food. Come on now. So I look at this and I'm just saying this is crazy. And my guess is if you were to pull together all these different account IDs that are pumping it, 4 followers. Oh, that's great. Doggy for life. So you're getting new accounts. Raja Khan is pumping Dogcoin. So just take a look at another stock just to get an idea. So this one I had a post this morning. This one I had a post, couple of posts yesterday. Not that exciting. So when you see Dogcoin having posts, crazy meme post. The battle for 24 cents is on. Come on now. All right, so I just want to share that with you because I think there's a lot of this market craziness going on about Dogcoin. So there you go. That's one of my points. So when this happens, this is very frothy. This is very exciting, but it's also very stressful on the markets because now you're dealing with what feels like fraud and manipulation. I said it. Fraud and manipulation. And so bad apples spoil the bunch. Just want you to be careful. Let's keep going. We talked about the federal deficit. We talked about the Russians. All right. Last thing I had on the list was to talk a little bit about something else, but I'm going to come back to the markets a little bit. So we're going to put that down for a minute. Oh, there's some code. Don't look at the code. Don't do it. It's gone. So the Russell. What is the Russell 2000? It's an index of small stocks. It's Main Street. It's retailers. It's new companies. Not so much tech, but like new small cap companies. It goes by the symbol up arrow or caret, RUT. It's an index. You can actually buy IWM, which is an ETF, exchange traded fund, that mimics to the best it can the Russell 2000. Then there's the Wilshire 5000, which is there in dark black. Wilshire, that looks and smells a lot like the S&P 500, but there's more stocks. Up to 5,000. I want to say it's like 3,000 stocks now. Then you've got the S&P 500, which is light gray. And that moves very closely with the Wilshire. We used to use the Wilshire in our model, and we took it out because it wasn't necessary. It didn't add a lot of diversification. And then you have what's in the red and green, because those are candles. You have the Russell. Oh, and I'm sorry, and the purple is the Nasdaq, or the tech index, the Nasdaq Composite 100. That's the 100 largest tech stocks, and other consumer-facing stocks. So what I want to show you is this is going back into March 31st. I mean, I can stretch this differently, but I just want it to fit the chart. I mean, that really makes the point, but I want to make the point differently here. So there you go. So if you look at the chart from around March 25th, and you're looking at something that I think is interesting, but maybe it's not interesting to you, but let's try it out. So the Russell was up at the end of March compared to the other indices. And it stayed above, meaning Main Street, small cap, stayed above the markets until April 6th. So the way I look at that is these are the people that are pushing up the small cap stock. So if you've got $1 million to invest and the company's only worth $10 million, you could bring some power to bear on that one stock. You could basically set the price, right? Because maybe $1 million stock only trades, maybe a stock that's worth, let's say, $10 million only trades $100,000 a day. And so if you suddenly double demand by buying $100,000 in a day, you can really pop the price. So the Russell stocks individually are easier to manage, they're easier to move. But as a group, there's a lot of them. And so it's a lot of money. It's a groundswell of support for small cap. And it looks like from the period of right around this little runaway peak here of April Fool's Day, it dropped. It flattened. It made a really quick dash on the 14th. It tried, and then it came down. And look at how much it came down. It came down about 4% lower than the other indices. Not to say the other indices didn't fall, but it fell further. And so I point this out because there's a divergence now, right? There's a disturbance in the force, to use Star Wars. And then what happened? This week, it popped back up. They're almost at the same exact point by the 22nd. And now you're within spitting distance. You're within a percentage and a half to 2% between all the indices. Kind of back to where you started a month ago. And so it's always interesting when you have this kind of sector rotation, right? This is a small cap, large cap rotation. Because what happens is with our model, we'll look at stocks that either have very little volatility and great movement, or stocks that are all volatility and no movement. So people are scalping. They're making money on the move. They're just playing in the volatility, right? Like a playground with 1,000 kids, but no one's getting out of the playground. That's the Russell, and that's what we've been seeing. And so this is a little strange in the market because it's almost like the people that were in the small cap stocks took a little break. They were pumping like crazy. By the way, the Russell is up far more than the S&P or the Nasdaq over the past year. It just is. I want to say it's like 90 points up versus 60. So it's up a lot more. So when it falls like this, it's pretty important. So if you're an investor and you're looking at small cap stocks, you made a ton of money basically starting on the 21st, so Wednesday. So Wednesday was a great day for you. Thursday was a great day for you. Friday was a great day. It looks like Thursday it dropped a bit in the afternoon, but still, you made money on Thursday. There was a little drop, and now you're back up again. And so you feel good. And I just think this is important because our model looks backwards. But when you see activity like this, you just got to kind of stop and say, okay, what's happening? Well, so a couple questions that come to my mind is, first off, where does the money come from? So if small cap companies are being bought by small cap people, by retail investors, then somehow the retail investors took a break for a week or two. Maybe it was spring break, I don't know. And then somehow, when the going got a little rough there, now they pop back in. It also could be institutional money, or big money, basically. Corporate money, big institutional money, could be a hedge fund, could be some of the big players. It's not that hard to pop up some of these small cap stocks. To take a $15 million company and pump it up, you might only need $500,000. You might be able with $1 billion to really pump up enough stocks that you really drive the market. We've seen stocks up 10, 20, 30 points this week. I mean, today was a pretty flat day, but just in general, it's been a really interesting day, right? And so we saw a sector rotation 2 weeks ago out of oil and gas. It could be people took money out of oil and gas, put it on the sidelines for a little bit, and then now pumping it into the small caps. I don't know. I just think it's something that you should know, you should be thinking about. Boom, let's drop that. So this is a U.S. recovery tracker. This is the conversation about the U.S. economy, which I think is very important for all of us to have, because the market, oh, by the way, the battle for 24 cents has been won. We're now at 24 and a quarter for Dogecoin. This is the excitement of these new cryptocurrencies. It doesn't even matter that you have to give 5 or 10% of your money back. You're like, yeah, I'm going to get in for a penny, or I'm going to get in for a quarter, and I'm going to sell it at $100. I'm going to make 400 times my money. This is great. I'm loving it, right? There's whatever there were, 5,000 stock twits and 10,000 tweets on it, and obviously people are excited. Well, no, obviously someone is paying people to promote new cryptocurrencies because they make a profit on the cryptocurrencies. But that doesn't matter. The fun story, the strong apes together story is we're going to hold the line at 25 cents. We're going to carry it to 50 cents. It's going to be great. Not realizing that 10% of every transaction goes into the pockets of the producer or the promoter. And it's a lot of money. So, and my guess is that you're going to find out that it's like a poker table, right? Where the house takes 10% of every hand. At some point, all the poker players are broke, except for the couple really good ones. And if you're watching my video, you might be one of the really good ones. I just want you to understand that the table stake is like 5, 8, 10% when you buy a crypto. Plus, there's the cost of the exchange and any issues you have there, right? These are not regulated stock exchanges where you're guaranteed the best price. You might be getting a bad price to get in. You might be getting a bad price to get out. So not only do you pay your 7 to 10% table stake, you might be paying a couple of points in, a couple of points out just on execution risk. So now let's go back to the economy. So this is what I talked about before, right? Weekly job data on initial jobless claims fell to a pandemic era low of 547,000 jobs. That's amazing. That's terrific. Housing is up. This is the U.S. recovery tracker. So I want to talk a little bit about this. So you can see we hit a low. We're up to really where we were pretty much before the pandemic. And production continues to rise. Mobility is starting to rise again. Financial stability is strong. The place where we're weak there is health. The U.S. recovery health is down. Well, people are dying. I'm sorry. So, yeah, we've lost health. But the economy's picking up. So I would say there is reason to be optimistic about the markets. I mean, there's even reason to be optimistic about Dogecoin because look at this thing. It's not hard for social media influencers to pump a financial asset, the price of a financial asset. And I did notice that many of the promoters for Dogecoin and SafeMoon came out of Asia, either Indonesia or other Asian countries. And so this is not even a U.S. activity going on. This is a foreign activity to pump crypto. We talked about oil. Let's go to FinViz. By the way, I love FinViz. Thank you guys. You do a great job. You guys are terrific. So I want to pull up 1 week performance. This is the S&P 500 over the week, and it's broken up by different industry sectors. So the semiconductor industry sector is pretty much either all red or red with a little bit of light green in there. Semis have been tough. Tech has been tough right now. Look at Apple, flat. Your consumer cyclicals are down. Tesla's down. Home improvement's down. Restaurants, footwear, right? The consumer stuff is down. Real estate looks great though, and real estate looks great because what we talked about a couple weeks ago is we're going to either need to build new houses, more houses. Right now, commercial property is empty, sitting empty. But on the real estate side, maybe not. And as people start going back to work, they may not want to work in those old buildings, dilapidated, decrepit buildings. They may want brand new buildings, brand new real estate with all the tech that you're used to at home. With high-speed internet, maybe not gig, but at least 100 megabits or more, you're going to want like fun. You're going to want like good stuff, right? You're not going to want old office space. And different industries, there's a lot of red and a lot of green. This is back to a stock picker's market. And if we take a look at the world, I mean, Japan's down. China is a mix. It's a mix. Looks like some Asian countries doing okay. India's down. Europe looks mixed, but okay. Mixed, I'd say. Brazil's up. Brazil hit a nice recovery this week. The rest of the world's pretty mixed too. There's mixed. There's a lot of down. It's been a tough week. Middle of the week, you had a little bit of a correction, a little bit of a drop, and just want to point that out. So, but again, if we go back to the S&P, if I remind you a year ago, we are completely bright green from a year ago, right? So anyone who got fully invested in April of last year made a ton of money. You had to work really hard to pick a loser. Vertex Pharmaceuticals, Gilead Sciences. I mean, it's hard to imagine finding losers like this. Who's the one in oil and gas? Oh, Cabot Oil, right? But you go back a month, you're still up. We've still had an amazing month, right? Get that. Now, energy's been down all month. Of course, we're long energy, so that's really terrific for us as individuals. And entertainment's down because of the Argos. The Bill Huang, who blew up. He had a lot of those stocks, and so we're still trying to sell them. Intel's down. Intel talked about the shortage and how maybe it's going to take a while to get back up. Nike's another story stock there for the month. Now you look for the week. It's been a very mixed week. You look for the day. Today's not a bad day. It was actually a pretty good day today in the markets. And so just something to think about, right? As you're trying to figure out where we are in the cycle, you start to see it. So, oil. One proxy for economic activity is oil that is stockpiled. So, people when they move, when they physically get in their car, get in an airplane, when they put things in trucks, right? They use oil and gas. And so we started building stockpiles when the pandemic hit. We were at 10 million barrels. And we hit 30 million barrels pretty quick. Johnny on the spot there within 3 months. And we got it up to 40, looks like almost 50 million barrels. And now, in April, we have been on a steady decline. So economic activity globally has sped up. And what this shows you is it takes time for oil consumption, so oil consumption moves fast. It takes the elevator. Oil production is slow. It takes the stairs. And so we just talked about it. Baker Hughes, you have one more rig in the United States, or one less rig in the United States than you did a week ago. It takes 6 months to get a rig drilled and tilled so that you're producing. 6 months. So this is why the price of oil moves as much as it does, because as that stockpile continues to drop, that looks like it's steepening and accelerating. If your stockpile goes to zero, and then globally you start to run out of oil, you're going to see the price jump, leap, crazy leap. And then the rigs come out. And then the oil field services go up. And then OPEC will start to either harvest those monopoly profits, OPEC plus, or everyone starts investing capital into the ground to start getting more oil to come up. And so I find this so interesting because this to me feels like it was a sad story early on. Now it's a positive story. And I got to tell you, I want to be in oil field services. I want to be in drilling. I want to be in pipelines. I want to be in E&P, exploration and production. If I come back in May and the stockpile of crude at Saldanha Bay is down to zero, oh yeah, I want to jump on it. I want to read about how the strategic oil reserve has to be tapped in most countries because we're out of oil. Because then we start to drill, and then we start to profit. And so, by the way, the price of gasoline though will destroy most families' budgets. So it's the bad part. Now let's talk a little bit about bonds. I know everyone's eyes glaze over when I start talking about bonds. In fact, look at the Wall Street Journal on bonds. How boring it looks. So many numbers. All the numbers are really small too, right? It's like, you can't even read this. This is terrible. Why do they make bonds so boring? Bonds are actually not boring at all. Bonds are very interesting. Okay? So, I want to talk a little bit about bonds. I want to say that U.S. government, U.S. credits, right? Yield 1.4. The low 1.0, the high 1.55. So we're kind of at the high end of the range there for government yields, but year-to-date return has been negative 3 and 1500s. We're not talking very much movement here. Movement here at all. So we look at the corporates, right? And so these are investment grade corporates. And so those yields, let's make sure I got the right, no, that's percent change. This is yields. How do I show that? It's going to be right here with the bold. Yields are at 2.16. Intermediate, length, long term, so you're at 1.5 to 3.3. So if you think about your average company, think about an IBM, you think about what Intel, they're probably paying 1.5 to 3.5 points on their debt. It's fine. If you're AA rated, it's 1.8. If you're triple B rated, you're 2.4. Some pretty small numbers. Now we look at high yield constrained. Constrained means I can only have a certain amount of my high yield in each bond. Now I'm at 4.1. If I look at my triple C rated, which is junk, complete junk, I'm at 7%. Now the lowest I'd ever seen this was 6.8. So I'm still pretty near the bottom of the barrel. So if you're a junk bond company, it's really cheap to borrow right now. And there's a lot of frothiness. There's a lot of positive feelings about junk bond issuers, at least in the U.S. Just to put it in perspective, like I did with the government number, this number's been 18%. So the spread on triple C rated junk bonds is 6.8 at the downside, 18 at the upside, and we're at 7. So now's a great time. Bond window's open. If you need to borrow money and you're triple C rated and you're a good company with good assets, but you just need more money, you just need more time, now's a good time. And you see, same thing, global numbers. So I point that out because it's so interesting. So now let's look at mortgage-backed securities. 1.66, 1.60, 1.67. Remember, mortgage-backed securities. Now let's look at the Ginnies, Fannies, and Freddies. 1.6, 1.8, 1.8. Our government has bought $2.8 trillion of them. So those yields aren't bad. If you believe that people are going to be able to pay their mortgage, despite maybe not having a job, that's going to be, easy money, right? Or the U.S. government will start taking people's houses. That's all I wanted to point out. Like U.S. issued high yield, U.S. corporate debt, S&P Dow Jones, 4. And the range there is like 3.9 to 8.3. So we're still at the low end of the range, but when you look at investment grade, it's 2.0. I just find it fascinating, by the way, for those listening. We're looking at 2% for investment grade and 4% for high yield. That's 2 percentage points. You're really going to trust a company from investment grade to junk, and you're only going to charge them 2% more for money? There's a lot of frothiness out there. Either that or there's a lot of money looking for a home. And that's what I want you to think about. There's money out there looking for a home. And so maybe you can get your piece of it. So I'm going to end with a quick discussion of our firm, Chicago Quantum. We are a service mark of the U.S. Advanced Computing Infrastructure Incorporated Company. We have right now 2 paying clients, one around stock market portfolio optimization, the other around media and entertainment. We're a U.S.-based corporation. We are a founding member of the Quantum Economic Development Consortium, QEDC. We're very excited to be part of that. And we have a Better Business Bureau A+ rating. We're accredited by the Better Business Bureau. Here are our NAICS codes. We publish our research. We have not published research in a while now, so we've been more focused on making money. We do have 2 client testimonials, and we do have services in production that we would like you to buy. We also have a website with all these investing questions and different investing info. I just want to show you. So there's people that want to know things like, where do you get your data, Jeff? Or where can I get stock market data, or stock market news? What do all these definitions mean? What's beta? What's a short squeeze? What's a gamma squeeze? What's gamma? What do all these things mean? Well, we have maybe 9 or 10 pages of detail, and we have links, all free, on market questions and market data. Then we publish each week negative beta stocks. We also publish the highest yielding stocks in the U.S. exchanges. And then we just had some interesting insights on Dogecoin or Doggycoin. We have our blog. By the way, our blog's full. So now we have a new blog where we put in our weekly picks, weekly blog entries, and that's there. So there's a lot of things here for people. And so if you like the stock market, you can kind of get lost on our website. And unfortunately, like how we make money is you either buy a project. Our rack rate is $250 an hour. We do negotiate. Love to negotiate. Love to sell you some projects. We'll actually give you a free t-shirt if you buy a project. Probably give you a free t-shirt anyway if you ask us. Buy analysis. You can pick efficient stock portfolios, finding that needle in a haystack. Right? Find the portfolio that does well. Or you could find the bears. You could find the portfolios that move but without direction. By the way, at a time when money is just pouring into the Russell 2000, probably not a good time to be holding the bears, because bears go down when the market is weak. When the market was weak this week and last week, wow, did these stocks go down fast. But when the Russell popped up, they went up real fast too. So these are just volatile, crazy stocks that we're saying they don't belong in a portfolio of a responsible person who wants a buy and hold strategy. And you can look at all the exchanges. We also will do custom development for you. This is more of a big ticket item, but if you're interested in using our solvers, matrix solvers, different solvers, genetic algorithms, 3 types of Monte Carlos, reverse and forward-looking simulated annealers, taboo, you name it. Oh, simulated bifurcators, portfolio optimization, or particle swarm optimizers. You might say, Jeff, I have my own idea on why the stocks are going to go up, so I would like you to program my idea with your solvers, and I'll give you $7,500 a week to do that. Great. Maybe we'll do it for you. And if you do a good run and you want to buy, you want a conversation, we'll have a good conversation with you. So, truth is, we'll work with you. And we've had investors make just a tremendous amount of money. We've had people be pretty happy with our work. And we're ready to serve. We are in the market and we are ready to do business. And here's how you contact us. And I am Jeffrey Cohen, President of U.S. Advanced Computing Infrastructures. Here's my bio. I'm on LinkedIn. Again, we're Better Business Bureau. If you'd like to suggest or request a quote, through the Better Business Bureau, you may. You just click on the Better Business Bureau logo, which I got somewhere on this website. Maybe it's in the home here. Here it is. You click right there, accredited business. Boom. Chicago Quantum. Been in business. We've been accredited since 2019. We've been in business for 10 years. And you want a quote, you click the button, get a quote. This helps you to feel confident that we're not a fly-by-night business. We're here to stay. And so I want to thank you again for listening. You guys take care now. Bye-bye.